Warren Buffett once called The Intelligent Investor the greatest investing book ever written. He's also said that reading it at 19 completely reshaped his life. And honestly, I get why. When I read it, it permanently changed how I think about money. Not because it teaches you how to beat the market, not because it promises some secret shortcut to wealth, but because it teaches you how to think about investing, about risk, patience, and discipline, in a way that protects you and helps you build wealth over the long run. So today I want to break down the 5 most important lessons from this book. These are the ideas that save people from painful mistakes, stop them from blowing up their portfolios, and show what it actually means to invest intelligently. Takeaway, Bar 1. Mr. Market. Let's start with one of the most powerful ideas in the entire book, and one that most people completely misunderstand. Imagine you own a small neighborhood coffee shop, nothing fancy, but it's profitable, has loyal customers, and pays the bills consistently. You're happy owning it. Now, imagine that every single morning, your strange neighbor, let's call him Mr. Market, shows up with a new offer to buy your business.
I'll give you $1 million. Coffee shops are booming. Coffee is finished. I'll give you 50,000. Take it or leave it. Actually, I changed my mind. 700,000 sounds fair.
And he does this every single day. Would you take him seriously? Of course not. You'd laugh, you'd ignore him, you'd tell him to come back when he makes sense. But here's the weird part. When it comes to the stock market, people treat Mr. Market like a genius. Prices go up. People feel smart. Prices go down. People panic and sell. Why? Because the market feels official. It's on screens. It's on the news. It looks authoritative. Benjamin Graham's point is simple. The market is emotional, irrational, and driven by fear and greed. Just like that unstable neighbor. You don't have to act just because Mr. Market is having a mood swing. Instead, you use him. When panic hits and prices fall, opportunities appear. When greed takes over and everything feels euphoric, that's when caution matters. Think about 2020. Strong companies like Apple, Microsoft, and Amazon didn't suddenly become bad businesses. Prices dropped because fear took over. The investors who understood this didn't panic, they leaned in. As Graham put it, the market exists to serve you, not to guide you. Your goal isn't to predict next week's price, it's to understand what you own, and act only when it makes sense. Takeaway. Number 2, investing versus speculating. This is where most people get confused. Investing and speculating are not the same thing. Investing is calm, deliberate, long-term. It's like buying a home you actually want to live in. You inspect it, you understand the neighborhood, you plan to stay. Speculating is the opposite. It's buying because someone told you prices are about to explode, without knowing what you're buying or why. True investing requires 3 things. You do real analysis, you protect your capital, and you expect reasonable returns, not miracles. The problem is, many people think they're investing when they're really gambling on hype. They buy stocks because they're trending, because someone online said, this is the next big thing. Not because they understand the business. Ask yourself this: would you buy part of a restaurant you've never seen, don't understand, and know nothing about, just because someone promised it would blow up? That's what people do with stocks every day. Look at the dot-com bubble. Companies with no profits, no products, and no business model were soaring until reality hit. Graham's rule is simple. A stock is ownership in a real business. If you wouldn't want to own the entire company, why own a tiny piece of it? That mindset alone puts you ahead of most investors. Takeaway, number 3, margin of safety. This might be the most important lesson in the entire book. Never buy anything without room for error. No matter how smart you are, things can go wrong. Businesses stumble, economies shift, markets panic. You need a buffer. Think of it like engineering a bridge. If the trucks weigh 10,000 pounds, you don't design the bridge to handle exactly 10,000. You build it stronger, just in case. That extra strength is your margin of safety. In investing, it means buying well below what something is worth. If you believe a stock is worth $50, you don't rush in at $50. You wait. You want a discount. That gap protects you. During the 2008 crisis, high-quality companies were selling far below their true value. Not because they were broken, but because fear dominated the market. That's when disciplined investors stepped in. And yes, sometimes great companies keep going up. It's tempting to chase. But a great business at a bad price is still a bad investment. Patience is part of the strategy. Takeaway. Number 4. Choose your investor type. Benjamin Graham made this very clear. You must choose what kind of investor you are. There are 2 types. The defensive investor wants steady growth with minimal effort. They use index funds, invest consistently, rebalance occasionally, and let time do the heavy lifting. The enterprising investor enjoys digging deep, reading financial statements, searching for undervalued opportunities, putting in real work. Both paths are valid, but mixing them is dangerous. If you don't have the time or discipline for deep analysis, stay defensive. If you love the process and are willing to work harder than most, go enterprising. Just don't drift in between. That's where mistakes happen. Takeaway number 5. Emotional discipline. This is the hardest part, and the most important. Graham believed that emotions destroy more wealth than bad analysis. When markets fall, fear takes over. When markets rise, greed takes control. The investors who win long-term are the ones who stay calm when others lose control. They don't panic. They don't chase hype. They follow systems, dollar-cost averaging, rebalancing, sticking to a plan. Like a pilot flying through turbulence, they don't react emotionally. They do reacting more, but mine. Bapunster is mine. Was so wadapan kurdar, the soberdakan 9. Without they follow procedures. You can't control the market, but you can control yourself. These 5 ideas work together. Think like a business owner. Demand a margin of safety. Use Mr. Market instead of following him. Know which type of investor you are, and master your emotions. That's intelligent investing. And this book goes even deeper than what we covered today. So, if you want a part 2, or deeper breakdowns of specific lessons, let me know in the comments. If this helped you, support the video. And I'll see you in the next one.